Welcome to Stocksage Insights, where we discuss investment ideas and provide insightful market commentary, tailored for savvy investors like you. I am Sir Faraz, and today, we're tackling a crucial question: could the markets crash in 2024? And if so, how should you, as an investor, brace for such a scenario? Let's dive right into this engaging topic. November was a standout month for the markets, with some impressive numbers on the board. Since the start of last month, the Dow Jones and the S&P 500 have gone up by around 9%. This positive trend has many on Wall Street feeling optimistic, and there's a reason for this upbeat mood. Analysts are predicting that the Federal Reserve might cut interest rates in 2024. This could be a significant development. Interest rate cuts by the Federal Reserve make borrowing more affordable for both individuals and businesses. It's like opening the floodgates for cheaper loans, which generally leads to more spending and investment. This increased financial activity can then translate into higher company profits. And when companies start doing better, their stock prices often follow suit, climbing higher. So, in theory, a rate cut by the Fed could be the spark that fuels a stock market rally. While a rate cut by the Federal Reserve can act as a stimulant for the stock market, it's just as important for investors to keep their eyes open to the risks as well. A key risk that we can't ignore is the possibility of a recession. It's like an uninvited guest that can show up unexpectedly, leading to a downturn in economic activities. In such times, companies might see their profits shrink, and this usually means a downward trend in stock prices. But let's be clear, this isn't a doom and gloom talk. My aim is to enhance awareness and encourage informed decision-making. Sure, rate cuts can give the market a boost, but it's wise to stay alert and consider the bigger economic picture. This includes being mindful of risks like recessions, which historically always emerge out of the blue. Now, there's a crucial factor at play here when we talk about recession. It's the delayed impact of rate hikes. Let's rewind a bit and remember that the Fed has increased interest rates 11 times since early 2022. The rates have soared to a range of 5.25% to 5.5%, marking the highest level in 22 years. This aggressive stance has been pivotal in bringing inflation down to around 3%. But here's the interesting part: even with these high interest rates, the US economy hasn't just held up, it has grown. In fact, the third quarter saw the US GDP expand by a robust 5.2%. While the current state of strong economic growth may give the impression that higher borrowing costs aren't affecting businesses, it's important to dig a little deeper. It's a common oversight to forget that the effects of monetary policy changes don't hit instantly. These changes usually have a lag on the economy that can span from 12 to 18 months. This means that the full impact of the Federal Reserve's rate hikes that brought interest rates to over 5% is likely to be fully felt only in the latter half of 2024. So, how does this delayed effect of monetary policy play out for companies listed on the US stock exchange? Here's where the crux of the matter lies. A significant number of companies are currently grappling with the challenges of refinancing their debt amid this high interest rate environment. Borrowing costs have risen, and there's no denying it. The era of free money, which lasted for about 15 years, has come to a close. Companies that once refinanced their debts at low costs are now facing the reality of much higher rates. The silver lining is that for many companies, a large portion of their debt dates back to the years of low interest rates, so only a fraction of the debt being refinanced currently faces these high costs. However, as time marches on and more debts mature, an increasing amount of debt will need to be refinanced at these elevated rates. Imagine a company that initially borrowed when interest rates were close to zero, now having to renew its debt in a market where rates are soaring into double digits. This scenario is bound to exert significant pressure on their income and earnings. A decline in earnings outlook can then lead to a downward spiral in their stock prices. Not every company will be equally affected by the spike in borrowing costs. It's reasonable to assume that companies with investment-grade ratings will face lower risks, while those with speculative grade ratings might find themselves in hotter water. For many of these speculative grade companies, their earnings might not be enough to cover the escalating costs of borrowing. As a result, their profits could take a serious hit, potentially leading to a crash in their stock prices. However, it's not just the speculative grade companies that need to worry. If fear starts to take root on Wall Street, driven by concerns over high borrowing costs, then even shares of investment-grade companies might begin to wobble. This kind of market anxiety could trigger a sharp drop on the stock market, and even the S&P 500 and Dow Jones could fall significantly. Recall that my initial assumption was based on the fact that it can take 12 to 18 months for the full impact of high interest rates to ripple through the economy. So, following this logic, it's quite likely that the current stock market rally could continue for a bit longer. But as we head into the second half of 2024, the situation might start to sour as more companies begin to feel the brunt of these high interest rates. This could usher in a wave of pessimism, potentially halting the bullish trend. In light of the potential risks we've discussed, let's consider how you might want to structure your investments if a recession looms on the horizon. One strategy is to recession-proof your portfolio. This involves reducing your exposure to companies that have poor financial health, particularly those burdened with heavy debt and weak cash flows. That's because in a market downturn driven by high interest rates, these financially strained companies are likely to bear the brunt of the turmoil. Their stock prices could fall more steeply than the broader market. Another smart move is to increase your holdings in defensive stocks. These are stocks that typically weather recessions well. Think about companies like Johnson & Johnson and Procter & Gamble. They hold up better because of the simple reason that consumer staples are essentials. Even in tough economic times, people still need to buy food, drugs, hygiene products, and medical supplies. Many of these companies also offer attractive dividend yields, adding to their appeal. For broader exposure to consumer staples, consider an ETF like the SPDR Consumer Staples Select Sector Fund, whose ticker symbol is XLP. This ETF pools together consumer staples companies from the S&P 500. With almost $16 billion in assets, XLP is the largest ETF in its sector. There's another silver lining in the scenario of a recession and market downturn. The recessions and the ensuing crash in stock market can present a golden opportunity to buy high-quality companies at a discount. Large-cap, well-established companies with strong balance sheets and robust cash flows might suddenly become more affordable. By investing in these stocks when the market dips, you can set yourself up for potentially significant gains as the market recovers. Remember, recessions are inevitably followed by economic recoveries. Since 1900, the average recession has lasted about 15 months, but markets often start to bounce back before the recession officially ends. Smart investments in top-notch companies during a recession can lead to outsized returns as the economy rebounds. If you liked the video, please smash that like button and don't forget to subscribe to StockSage Insights. If you find my content valuable and want to support me, please back me up on Patreon. Before I wrap up, I must remind you that everything you've heard in this video is just my opinion, not financial advice. Until our next video, keep your investment game strong.